As the holiday season reaches its peak, a wave of optimism is sweeping across Wall Street, lifting investor spirits and infusing the financial district with a sense of hope and excitement as the year draws to a close. The festive atmosphere is unmistakable, with offices decked out in holiday decor and traders exchanging cheerful greetings, all while keeping a close eye on the markets. U.S. stock futures are pointing to a strong start for the week, with S&P 500 futures up 0.3%. This uptick is fueling hopes that the momentum seen in recent sessions will carry through the final days of the year, giving investors a reason to celebrate. Meanwhile, Nasdaq 100 futures are climbing 0.5%, reflecting renewed enthusiasm for technology and growth stocks that have been at the heart of this year's market story.
On this Monday, December 22, 2025, markets look set to extend a year-end rally that's been gaining steam for weeks. The anticipation is palpable, as investors and analysts alike wonder just how far this rally can go before the year wraps up.
Investors are focusing on growth, especially in technology, after a year of navigating uncertainty, inflation concerns, and shifting economic signals. The resilience of tech stocks has been a bright spot, drawing attention from both seasoned traders and newcomers eager to participate in the next big wave. The S&P 500 just posted its best single-day gain in nearly a month, fueling hopes for a sustained rally that could cap off the year on a high note. This surge has injected fresh energy into the market, with many now speculating about new record highs. The driving force behind this optimism? The transformative potential of artificial intelligence. AI is not just a buzzword. It's reshaping entire industries, from finance to healthcare, and investors are eager to be part of this technological revolution. After months of skepticism and debate about whether the AI boom was overhyped, confidence is roaring back. Investors are now betting big on chipmakers and software giants, convinced that these companies will lead the next era of growth.
AI is increasingly seen as a fundamental shift, not a passing trend. And that belief is powering the current rally. The sense is that we're witnessing the early stages of a technological transformation that could redefine the global economy.
This rally feels different, centered on innovation and future profits, not just broad economic factors. There's a sense that the market is rewarding companies that are shaping the future, rather than simply reacting to short-term news or policy changes.
As we enter this holiday-shortened week, hope and the promise of AI are setting a positive tone for Wall Street. The mood is upbeat, and many are looking forward to what the new year might bring for markets and technology alike.
The market's optimism is contagious, spreading from trading floors to boardrooms and even to everyday investors watching from home. It's a testament to the powerful stories and innovations that drive financial markets, reminding us that, especially during the holidays, hope and vision can be just as important as numbers on a screen.
The heart of today's market optimism is artificial intelligence. Tech stocks, especially semiconductor companies, are rebounding as investors regain faith in AI's long-term potential. Investors are looking past short-term challenges, envisioning AI integrated into every aspect of life.
The Nasdaq's recent outperformance reflects this renewed enthusiasm.
Strong outlooks from key industry players are boosting confidence and calming fears about overvaluation. The narrative is shifting from speculative excess to sustainable growth. Technology and semiconductor sectors are once again seen as the engines of the market's advance.
Renewed AI optimism is lifting the entire market as investors look to the new year.
Micron Technology's strong forecast last week sparked a surge in AI-related optimism. The company's upbeat outlook reassured investors about real demand for AI hardware. Micron's products are essential for AI, and its confidence signals strength for the whole sector.
The news validated high valuations and rekindled enthusiasm for AI stocks.
Micron's announcement lifted not just its own shares, but the entire semiconductor industry. It created a positive feedback loop, boosting companies across the AI supply chain.
For investors waiting for proof of AI's substance, Micron's guidance was the sign.
The company's performance shows AI growth is real, not just hype.
This has been a key factor in the market's renewed focus on technology.
Oracle's shares jumped after news of its involvement with TikTok's US operations. Oracle is set to provide cloud infrastructure for TikTok, a major win in the competitive cloud market. This deal is a huge boost for Oracle's credibility and could attract more big clients.
Securing TikTok as a client demonstrates Oracle's ability to handle massive, high-profile workloads.
The market's reaction shows how significant this is for Oracle's cloud ambitions. The partnership could reshape perceptions and accelerate Oracle's growth. The Oracle TikTok story highlights the value of data and the critical role of cloud infrastructure. As digital life expands, demand for robust cloud services will only grow.
Oracle's success adds another layer of optimism to the tech sector.
Last week's market performance was a study in contrasts, with some indexes showing strength while others lagged behind. This divergence revealed exactly where investor confidence is currently concentrated and highlighted the sectors driving momentum in today's market. The S&P 500 managed to finish the week with a modest gain, demonstrating resilience in the face of mixed economic signals. This small but meaningful uptick helped set the stage for the rally we're seeing this week, as investors continue to look for stability and leadership among large-cap stocks. The Nasdaq, on the other hand, outperformed its peers, rising 0.5%. This gain was fueled by renewed enthusiasm for artificial intelligence, as well as strong earnings and positive news from companies like Micron and Oracle. Tech stocks, especially those tied to AI, have become the clear leaders in this market environment.
Meanwhile, the Dow Jones Industrial Average fell 0.7%, reflecting a noticeable rotation out of traditional sectors like industrials and financials, and into technology. This shift suggests that investors are seeking growth opportunities in areas with more innovation and future potential.
This divergence between the indexes makes it clear that the current rally is highly focused on technology and AI-related companies rather than being a broad-based market surge. Not all sectors are participating equally, and that's an important distinction for investors to keep in mind. The Nasdaq's impressive strength, combined with the S&P 500's steady performance, highlights just how powerful AI-driven optimism has become. These trends are shaping the overall tone of the market and influencing where capital is flowing.
The Dow's recent weakness serves as a reminder that not every sector is viewed as a growth engine right now. Traditional industries are facing headwinds, and investors are being selective about where they put their money.
Still, the momentum in technology is undeniable, and it's setting the dominant tone for the broader market. As long as tech and AI continue to deliver, they'll likely remain in the spotlight. Last week's performance laid a solid foundation for the current rally, and all eyes are now on whether this tech-driven momentum can carry the market even higher in the weeks ahead.
Another force behind the market's strength is the growing expectation that the Federal Reserve will soon lower interest rates. This hope has become a key driver for investors, who are closely watching every signal from the central bank. The possibility of cheaper borrowing costs is fueling optimism across Wall Street, as lower rates can stimulate economic growth and make it easier for businesses to expand.
After years of steady rate hikes aimed at controlling inflation, recent economic data suggests that the tightening cycle may finally be coming to an end. Inflation has started to cool, and the labor market is showing signs of stabilizing, giving policymakers more flexibility. Investors are now looking for any indication that the Fed is ready to pivot toward a more accommodative stance.
Many market participants now believe that rate cuts could arrive as soon as 2026, or possibly even earlier if economic conditions warrant. Lower rates would reduce the cost of borrowing for companies, encouraging them to invest in new projects, hire more workers, and pursue growth opportunities that were previously too expensive.
At the same time, falling Treasury yields are making stocks more attractive compared to bonds. As yields decline, the returns on fixed-income investments become less appealing, prompting investors to shift more money into equities in search of better returns.
This environment has especially benefited growth-oriented tech stocks, which tend to thrive when borrowing costs are low and future earnings are valued more highly. The tech sector, already buoyed by innovation, is seeing even more momentum as a result.
The combination of excitement around artificial intelligence and the anticipation of Federal Reserve rate cuts is creating a powerful rally in the markets. Investors are betting that these two forces together will drive significant gains in the months ahead.
With the prospect of profit growth and lower borrowing costs, investors are feeling more confident about the future. They see opportunities for both companies and individuals to benefit from a more favorable financial environment. This dual support, optimism about innovation and the likelihood of lower rates, is a major reason for the market's current strength and resilience.
As 2025 draws to a close, optimism about both interest rates and technological innovation continues to drive confidence among investors, setting the stage for what could be another strong year for the markets.
The holiday schedule will noticeably impact market activity this week.
With Christmas approaching, trading volumes are expected to drop as many investors take time off.
U.S. markets will close early on December 24 and remain closed on December 25.
Low trading volume can exaggerate price moves, making the market more volatile or unpredictable.
Even small news can cause big swings in a thin market, so investors should be cautious.
Sometimes the holiday period is calm, with markets drifting upward in a Santa Claus rally.
Optimism and low volume can help maintain positive momentum.
The key is not to overreact to short-term moves during this quiet, quirky week.
Even in a quiet week, key economic data can influence the market.
The delayed third-quarter GDP report will offer a final look at recent economic growth.
December's consumer confidence data is also crucial, as it reflects the mood of American shoppers.
Strong consumer confidence would signal a healthy holiday season and support the rally.
November's weak sentiment raised concerns, so December's reading is under the microscope.
These reports shape the narrative about whether the economy can achieve a soft landing.
Strong data would reinforce hopes for Fed rate cuts and boost stocks.
Even in a slow week, these numbers can move markets and set the tone for 2026.
Looking ahead, markets are watching the upcoming leadership transition at the Federal Reserve.
Jerome Powell's term ends in May 2026, and President Trump is interviewing finalists for the next Fed chair.
The Fed chair's decisions on interest rates affect everyone, from corporations to homebuyers. The chair's communication can move markets instantly, making the choice critical for investors.
Markets value predictability, and a new chair brings uncertainty about future policy.
The key question: will the new leader focus on fighting inflation or promoting growth? As finalists emerge, markets will react to their perceived policy leanings. This transition adds complexity to the long-term outlook.
As 2026 approaches, the Fed chair decision will become a major focus for investors worldwide.